Welcome back. You're still tuned into Halftime Report on CNBC-TV18. Let's talk about specific companies now. Dr. Agarwal's healthcare reported what was a strong Q3 performance. The revenue grew around 23%, while the margins did remain healthy this time. Growth was driven by higher patient volumes as well as improved performance from their mature centers. We have Dr. Adil Agarwal, who's the CEO of the company, now joining in to discuss the performance and the quarter gone by. Dr. Agarwal, thank you very much for taking the time out. Well, just wanted to start by asking you about your margins. You did open 14 centers this quarter, but you did manage to maintain your margins at 27% despite that. What's the secret?
Ekta, firstly, thank you for having me on your show. So we are very happy to report a very healthy growth in Q3, where our revenues have grown over 22%. Our EBITDA margins also have grown 23%. So this just shows that we have been able to grow our margins healthily despite opening 14 new centers. What this shows is that the brand visibility is slowly increasing since our listing. We also have stronger ops teams right now, so we've been able to ramp up our new centers a lot faster. So despite that, despite opening this many greenfields, if you're able to ramp up your centers faster, you're able to maintain your margins. That's a very healthy sign in terms of how we are ramping up operations. Another important thing which has happened pretty well is our same-store sales growth has been north of about 14-15%, and that is actually helping you bring in a lot more flow through your bottom line, which is again helping you retain your margins.
All right.
I think these two factors have actually helped us maintain our margins, not just in these 3 months, but over the entire year.
All right.
We see our margins have hovered around the 27-28% EBITDA margins, despite opening about 38 new centers this year. Right, so I think that's a significant achievement, and kudos to our operations team and our doctors for the fabulous work that they've been doing.
Okay, so same-store sales growth stood at around 14%. What I wanted to understand was your surgeries. Your surgery volumes, I think, were up around 11 to 12% this quarter. Just take us through, cataract as well as robotic cataract. What is the difference when it comes to margins between the two surgeries? Because we understand robotic is more complex. Do you charge more for that? Is that where the trend is now moving?
So Ekta, if you see our overall business, about 65% of our business comes in from surgeries, out of which a sizable chunk of our business comes in from cataract surgeries, which is obviously a very prevalent disorder in India. Now, cataract surgeries can happen in two forms. You can do your traditional cataract surgeries, which is phacoemulsification, or you do something what we call as femtocataract surgeries, which are robotic cataract surgeries. Robotic cataract surgeries, now we have about 8 to 9 machines which do these surgeries across the country. And they obviously are priced a little higher compared to your traditional cataract surgeries. Your margins in your traditional cataract surgeries are relatively healthy. They're anywhere between 77 to 78% gross margins. Your robotic cataracts will be slightly higher, given that you are charging a slight premium for doing femtocataract surgeries.
Okay. Dr. Agarwal, you spoke about how you added 39 centers in the year so far. You have around 60% presence in North, and you are expanding, South, and you're expanding in North now as well. How much of the addition came in from North, and what is the outlook going forward in terms of center addition? How will you fund that capex?
So we launched 3 new centers in Delhi this year. So this was our first entry into Delhi. We started off with one large facility in South East, and then we have launched a facility in Gurgaon, a third one in Preet Vihar. So this particular region now is going to be a big focus for us over the next 4 to 5 years. Given the kind of response we have had in the Delhi market, we are very happy to share that the patients are responding well to us, and we are having a good response from the local market. So we will be seeing sizable expansion in this particular market. Most of the capex for our new centers, and we are looking at adding about 55 to 60 new centers every single year, at least for the foreseeable future. Most of this capex expansion will happen, which will be funded by internal accruals, and we will be raising some small amount of debt. We also have some funds available from our IPO proceeds, which is again being deployed towards setting up these new centers.
All right. Just narrowing down on guidance, revenue growth of 20% as well as profit growth of around 35%. I think you're in line to achieve that?
Yes, Ekta. So I think, by God's grace, we've been able to do well. So we have been able to meet our revenue guidance of 20%. And if you look at our PAT growth has been about 74%, which has been quite sizable.
Yeah.
So we
So
are.
what does that mean for FY27, Dr. Agarwal? You know, FY26 looks steady, but FY27?
Look, our endeavor for FY27 is to maintain this kind of growth, and that's what we're focusing towards. This will come through a combination of both, same-store sales growth, where our existing centers will continue to grow, and we will be adding about 20% new capacity. So if you're at about 200 centers, we're looking at adding about 50 to 60 new centers over the year, so which will cater to the remaining balance, about 5 to 6% of growth. So we should be able to maintain a similar guidance in terms of what we have provided in FY26 for next year as well.
All right. So maybe assuming 20% growth in terms of revenue as well as 35% growth in terms of profit for FY27. We'll take a short break. Dr. Agarwal, thank you very much for joining in and speaking with CNBC TV.